expect the respective banks in their jurisdiction to follow. Because so, can anyone guess what's the reason behind having stress testing? Why do you really need to do stress testing? Anyone?
So because you need to understand how strong your system is in abnormal market situations.
Correct. Good. So we need to know that whether a bank is robust enough to handle any kind of stresses as they build along the way, because you never know when a market stress builds up, and it can build up really quickly, which can make things difficult for any bank. So the regulator expects banks to have ample amount of capital, or maybe they should have their models or systems which are robust enough to handle any kind of potential system stress as which may build up in the near future, so that they don't have to come back to the regulator every now and then for rescue or any other help. So that's why stress testing is required, and something which banks follow on a day-to-day basis, something which they may not report it on a daily basis, but that is something which has to be done. And the regulator might come calling, asking for these reports at any point in time. Yeah, I think someone has raised hand. Yes, Mehir,
Yes,
please
sir.
go
Sir, in this context of bank and stress testing, would
ahead.
it be fair to say that NPA monitoring is a part of stress testing, not only just a large part, but you can say a minor part of it?
Yes, definitely. So I won't say minor. Actually, it's a pretty important part, because when we talk of credit risk management, NPA analysis happens to be one important measure of knowing how much credit risk one is carrying on their books. So there is if you guys are familiar with Ind AS accounting standards, so there is either Ind AS or even IFRS 9. So IFRS 9 actually requires banks to do some bit of loss provisioning. So at the time of loan dispersal, banks are expected to do some bit of modeling, so that they can have at least a rough idea of what could be the potential default which can happen on a certain loan which they sanction. So that way, loan loss provisioning is a way in which banks try to tackle the problem of NPAs. So is everyone familiar with the concept of NPAs? What is an NPA? And how do you decide when a certain account becomes NPA? Is everyone familiar with that?
Yes, sir. I think it's if the repayment has not been made for 90 days, then it's
Correct.
classified as an NPA, in my opinion.
Correct. Yes. So if there is no interest or principal payment which has happened over a 90-day time period, we say that a certain loan has become an NPA. And whenever a loan gets classified as an NPA, that becomes like a, a like a capital hit for the bank, because something which is classified as NPA now, the interest and principal which was due from a certain borrower, which could have been used in the overall income statement calculation, that gets dropped away, because we don't really receive anything from a certain borrower. So that's why, I mean, NPA monitoring is a very important metric, and every bank is very, very careful about their overall NPA management. Everyone wants to keep the NPA levels to the minimum, because higher the NPAs, higher will be the loan loss provisioning which has to be done, which has a final impact on the bank's P&L. Yeah, so a very relevant question. Yes, NPAs are may be considered along with stress testing. I won't say it's exactly stress testing, because this is more of a thing which bank will do as a part of its business operations. Yeah. Next will be also for your trading purposes. So why trading? Because finally, every bank has a very active front office, which we also call as a Grover Markets Group. So those guys are there to do the trading for the bank's portfolio. So a few of them could be for their own books, and the remaining could be for their client portfolios. But yes, for deciding on a certain trading strategy, every trader might want to know how much a certain option is worth. So trading could be another area. After that, maybe exposure monitoring. So we'll be spending time understanding exposure monitoring in our future sessions as well. But for exposure monitoring, one needs to know how much a certain option position is worth, so that we know how much we owe to a certain customer. So that way, exposure monitoring can be done easily. So I'll tell you the approaches for exposure monitoring as well. Next, it can also be used for any kind, of course, I mean, capital charge or any kind of regulatory capital, I would say. So capital charge or credit value adjustment or off balance sheet charges, etc. So have you guys been introduced to these concepts before? I mean, what is a credit value adjustment or what is a off balance sheet capital charge, etc.? So was that covered at any point in time in any other subject?
So some of these concepts we've covered under an optional subjects for FE. It's called
Okay,
commercial
okay.
banking, but I doubt
Oh,
IB has done that.
okay, okay. Yeah, yeah. With you saying no, so I think IB might not have covered that. So, but no problem. Along the way, we'll cover a bit of capital charge and capital adequacy framework as well, because if we are talking from a risk management perspective, having a good idea of these things is also very, very important. So we'll talk a bit about that. But for now, I mean, for computation of all of these economic capital stuff, something which you require as a part of your regulatory reporting on a daily basis. Uh, Again, option pricing gets used as well. Next, it can be used for collateral monitoring. So banks frequently exchange collaterals because they are required for management of credit risk. So collateral exchange ties up really closely with exposure monitoring. So depending on the amount of exposure which I'm carrying on my books, I'll be exchanging a certain amount of collateral with my counterparty, because when I know that I hold a certain exposure to a certain XYZ party, I would always want to reduce the possibility of any kind of exposure owing to credit default. So imagine that my counterparty is to default overnight, then I would be losing a substantial sum of money. So through a daily collateral exchange, every bank will try to minimize that exposure. So I'll tell you the mechanism for collateral exchange along the way. So when we talk of risk management in general, I'll give you an idea of how banks exchange collateral on a day-to-day basis and how exactly option pricing ties there as well. Other than this, I would say even from a fund management perspective, this is important. So if we talk from a mutual fund house perspective, they also use options for a variety of reasons. So generally, fund houses would tend to use options for maybe changing or managing the risk of their portfolios. Very few may use it for trading. Of course, if we talk of a hedge fund or something who is very active on the derivative side of things, then yes, they will definitely go in for active trading and options. But otherwise, I would say they would stick more to the risk management side. So we have risk, portfolio valuation, risk management, stress testing, trading, capital adequacy, exposure. Yeah, I think this is more or less covers quite a few relevant areas where option pricing gets used. There may be a few additional places as well, where option might be useful, but these are the prominent ones. So any questions on this?
Sir, I had one question. It's more of a regulatory one.
Uh-huh.
Sir, there is a bit of confusion. Are mutual funds allowed to use derivatives or not, like forwards and all?
So as far as I recollect, they can use it for risk management purposes. For trading purposes, that is something which you have to check the guideline. So of course there will be a regulatory guideline. If it is not allowed for them, then that will be clearly specified in the circular. So that is something which you have to check out. But otherwise, for risk management, yes, I mean they can definitely use derivatives.
Okay, sir. Thank you.
But of course, any specifics pertaining to the regulatory side, I would say the best way is to refer to any specific guideline which is pertaining to that industry, and that would be the best source of just verifying things. Then difference between discrete time and continuous time models. So we had briefly spoken, I think. So did we briefly talk about discrete and continuous time in any of our previous discussions, either for FE class or maybe in the previous week? Or maybe have you guys been introduced to discrete and continuous time systems in the past?
So with respect to variables, we have been introduced. I think time would
Okay.
be rely on the same thing also.
Okay. So something like this. If I take the simple time value of money calculation, I could write it in the discrete time form as something like FV is equal to PV into 1 plus R raised to T. And for a
Yes, sir.
continuous time,
This and for continuous for it, we will do exponential. This part
correct.
I
I'll
will
need
do
an
manually.
exponent. Correct. E raised to r. Correct. So yes, this is the representation, discrete and continuous. But what is the idea behind having a distinction between these two systems? So, so what's the significance about discrete time and how different it is from a continuous time? So, would anyone like to elaborate that? So, maybe in plain English, so that everyone will find it easy to understand.
Sir, it would the values for two different scripts would differ in terms of compounding because the continuous time, as the name suggests, it is compounded every day, every second.
Mhm.
Whereas discrete time is at regular intervals. So there always be a slight difference. I would imagine continuous to be a bit higher.
Correct. Of course, yes. Continuous will definitely be higher, as you rightly said, because you have compounding which happens at a faster rate. But to put it very simply, and if I had to describe what is a continuous and a discrete time model, so maybe we could discuss discrete time first because that's what the binomial model is, and that is comparatively easy to understand as compared to continuous ones. So when we say a discrete time system, that implies that you have a finite number of outcomes for any event. So let's say a simple example can be maybe a coin tossing experiment. So if I toss the coin 6 times, then I have 6 outcomes. So that way, I have those specific number of outcomes which I can manually count. So whenever you have such a setup whereby you can actually count those specific outcomes which are happening, that is what you tend to call as a discrete time model. So maybe one example is the binomial one. So if I just show you a simple representation of a binomial model, it would be something like this. It's just a two-step binomial. You can have more number of steps as well. So let's say this is t equal to 0, t equal to 1, t equal to 2, and so on. So that way, if you see that I have finite number of states, so these are some things which I can manually count. So even if there are n number of steps, I can definitely count these individual states. And this is what we call as a discrete time representation of something. So this is one of the models. So in fact, this is the thing which we'll be studying in detail when we talk of the binomial variety. But this is what we call as a discrete time setup. So something which you can show pictorially as well as something which you can manually count. That is the outcomes which you can manually count is what you call as a discrete time system. Whereas for a continuous time system, unfortunately, you cannot draw a picture because a continuous time happens in the limit t tends to 0, or maybe delta t or dt tends to 0, whichever. So this implies that a value of dt or the time increment is very, very small. That is, now this becomes subjective. So why I say in the limit, because I don't know how much dt is going to be. So dt could be, let's say, 0.01, or someone may say this is not enough. I want a 0.001, and so on. So that way we are trying to reduce the time step further and further. That is, we are making it smaller and smaller. And that's why we say it is in the limit dt tending to 0. So a Black-Scholes model is an example of a continuous time model. So you can imagine these to be, so Black-Scholes, Black's model, all of these are just types of continuous time models and something which is difficult to show on paper. So I can't really show a diagram like the binary one or like the binomial one. So that's why we always study the discrete time first and then we study continuous, because many concepts which we study as a part of discrete time models can be readily applied to continuous time as well. So that's like a gradual step up which can happen. No one stops you from doing continuous directly. But things can become slightly difficult because generally something which you can show via a picture, that is comparatively easier to understand when you're studying these types of models for the first time. So we'll also do the same thing. We'll do a quick thing on binomial. So maybe this lecture and maybe some part of the next class before we go on to continuous time systems. Because concepts like risk neutrality, no arbitrage, delta hedging, these are the ideas which get used in the continuous time or the Black-Scholes model as well. So once we are familiar with that on the binomial front, extending that to continuous time is comparatively easy. So this is in brief how you can differentiate between a discrete and a continuous time system. So does this sound okay?
Yes, sir.
Okay. So popular option pricing models, you have binomials, Black-Scholes, you also have a Black 76 model, etc. Methodology for implementation, this is something which we'll cover in detail when we talk of numerical schemes. So we'll not really get into this variety right now. We are going to stick to the first approach now, that is the tree structure, because we have binomial trees which we work on. So we are going to understand that. Of course, now before we get to a simple numerical example, we would cover some underlying concepts which will be useful for anything which you study on options going ahead. So ideas of no arbitrage and risk neutrality. So that is something which we'll study first. And once we are comfortable with that, then we'll extend our calculation to a simple numerical so that we know that how exactly you can set up your binomial model. So for the majority of the part of today's class, I'm going to stay on the whiteboard now. So let me just switch screen. So any questions up till now? Because financial economics class might have maybe familiar with a few of these things, but IB class for you guys, this thing might be new. So any questions so far? So maybe why we are studying options, or maybe why do we need to study certain intricate concepts? Any question you have, feel free to bring up.
So why options are studied more deeply than futures?
Because the thing is, futures are linear products, and futures firstly trade on exchanges. So something which transacts on an exchange is, firstly, you already have a ready price which is available for a future. So you don't really have to do much. You simply have to go to the exchange website and look at the closing price. So in India, we have the Bhav copy. So if you simply download the Bhav copy for a particular day, you know what the position of every futures contract is on that particular day. So that way, there's no separate pricing as such which is required. Whatever price gets transacted on the exchange, that is the price. So you may be having some sophisticated model for futures, but no one would accept that, because people will say that we have exchanges which are quoting the price. So whatever the price the market decides, that's the right price. Whereas for options, that may not be the case always, because options trade on both the avenues, on exchanges as well as OTC. So those which transact on the exchange, yes, you have a traded price which is available for consumption. But on the OTC market, which is far bigger as compared to the exchange, we don't really have ready access to what could be the price of a certain option. So that is where option pricing gets used or is required. And again, the second point is non-linearity, because the thing is, options are inherently non-linear in nature, whereas forwards, futures, FRAs, etc. are simpler products and they are all linear ones. So whenever there's non-linearity, you need some bit of sophisticated modeling in order to understand how a certain product is behaving. So that's why we generally tend to study option pricing more in depth as compared to futures or even forwards for that matter. Okay. So let's begin with the idea of no arbitrage pricing. So we have discussed no arbitrage and the idea of no arbitrage the last time. So when we discussed put call parity, and we did a simple numerical on put call parity to see if there is an arbitrage opportunity, how do you capture that arbitrage? So that is the same concept of arbitrage which we are planning to use here as well. So now what we are trying to do is we are trying to create a portfolio which is riskless in nature. So when I say riskless in nature, I want to have my portfolio such that no matter which place I end up, so when I say which place, for binomial, I honestly have just two places to go. Either I go to the top node or I come to the bottom node. So whether I end up in any of these two, my portfolio value should not get impacted. And when I can do that, I can say that I have eliminated the riskiness in my portfolio, because I know with certainty that I will be ending up with a certain portfolio value at any of these points. So this is something which I'm trying to do now. So we'll take a simple one-step binomial to demonstrate this. So firstly, maybe we can take a simple, we can just plug in some sample values, because those values are something which will help us relate with risk neutral concept as well. So this, you can imagine, is concept number 1 for today. And concept number 2 is going to be risk neutral valuation, or risk neutrality as we call it. So we'll talk a bit about that in the subsequent part of today's class. So we'll do a simple numerical for no arbitrage bit. I won't exactly say numerical, we'll just plug in numbers to have a value for comparison. And subsequently, we'll do some generalization, because finally we want to apply this for a multi-step binomial. Now here, for simplicity, we'll take a one-step binomial. But in practice, it's never a one-step tree which you use. You always use multiple steps. So instead of this, you may generally end up using something like this. So this is like a two-step. You may also want to have further steps. So a three-step binomial and so on. So that way you can just keep on increasing the number of steps, but the concept which we apply for studying the one step can be applied for a multi-step binomial as well. So that is something which we are trying to understand now. So, any questions? Also, I mean, IB guys, are you finding this approach to be okay? Is it manageable? Because the IB class is learning these concepts for the first time. So anything which you feel difficult, please let me know. And if you find a certain concept which is difficult to grasp, let me know. I can just repeat that quickly. All right. So I'll just delete risk neutrality for now to avoid confusion. So let's understand a simple setup. So let's say I have my portfolio, and my portfolio is made up of long delta shares or delta number of shares. So imagine delta is a value and I'm short one option. Now, which option I'm using, that is not of concern right now. So whether it's a call or a put option, that's not a problem. Imagine it's a European option which we are looking at. And my aim, what I'm trying to accomplish, is to create a portfolio that is riskless. That is, I have to figure out the value for delta. So figure out delta that will make the portfolio riskless. So this is what I'm trying to accomplish. So this is given to me, and this is my target. So let's see how that can be done. So let's take a simple one-step binomial. Let's say this is my S0. Let's say this is S1. Let's say this is S1 dashed. Imagine that I have a current stock price at 20. Let's say stock price at scenario 1 is maybe something like 22. This is like 28. And I have my option payoff as, let's call this as maybe P1 as 1 and P2 as maybe 0. So again, I have just taken hypothetical values for demonstration, so don't really worry about how we have come up with these numbers. We'll later on see how do we get S1, S1 dash, how do I calculate P1, P2, etc. Now, these are just random values just to demonstrate a concept. So don't worry about the sanctity of these numbers. That is not required right now. We'll just figure out how to make this portfolio riskless. So let's see our portfolio at S1, how it looks like. So at S1, my portfolio would look like 22 delta, because the stock price is 22 and I am holding delta number of shares, minus 1, which is my option payoff or option price. And this is, so I can say this is as equation A maybe. Let's say I call this as equation A. Let's see what happens at S1 dashed. So I have 18 as the stock price or underlying price. So I have 18 delta because I have delta number of shares, minus 0 because option price is 0 for this node. Let's say this is 2, or let's say this is B. Now, since I want to create a portfolio which is riskless, I'm going to equate A and B together because I want to calculate that value of delta, which will make my portfolio riskless in nature. So let's say this is my step 1, this is my step 2. As step 3, equate A and B. So I do a 22 delta minus 1 equal to 18 delta minus 0. You can drop the 0, but I've just written it so that it's easier to relate to the earlier step. Now, if I calculate delta here, so this will give me delta to be, so this is 4 delta equal. So delta equal to 1/4 or 0.25. Now, these are fractional number of shares. Now, in reality, you cannot transact fractions. It will always be an integer number, but for our demonstration, this is fine because we are not really transacting real shares at the moment. We are understanding a concept. So our optimal value of delta, I would say it's 0.25 shares. So to see if this is right, that is basically seeing that for this value of delta, we end up with the same portfolio value at both nodes A and B. Let's try to plug in this value of delta into both A and B and see how much this comes out. So as step 4, plugging in delta in A and B. So in A, that is at S1, we end up as 22 into 1/4 minus 1. So it's 4.5. And at, sorry, this is at S1. And now I have an S1 dashed as well. So it's 18 into 1/4 minus 0, so which is 4.5 as well. So that way, be it S1 or be it S1 dashed, whichever node I look at, I always end up with 4.5 for this specific value of delta. So as long as I hold 0.25 shares in this portfolio for this one short option, I am hedged, or that means I have eliminated any kind of uncertainty. Why I say that? Because there are only two possibilities which I can go to, right? I can either go to S1 or I can go to S1 dash because I'm starting a binomial model. I don't have any other step which I need to worry about. So for both of these nodes, I end up with 4.5. And this is where I can say that I have made my portfolio as riskless in nature because I don't have uncertainty about where my portfolio is going to be at one step ahead, which is on the cross section where S1 and S1 dash lies. So you can imagine this to be like t equal to 0. And let's say this is something like a 3 months away or something. So that way, standing today, I don't need to worry about where this portfolio ends up because by holding this position right now, I have hedged away my risk. Now, if I would want to know what is the option price for setting up this portfolio, because finally I am interested in what is happening at my initial node. Because when you say you're pricing an option, what you're essentially trying to do is you're trying to estimate how much the option is worth today, i.e. you're trying to understand the fair value or MTM of the option as we call it. So we are finally trying to figure out the best estimate for the option price as of today. So imagine I'm interested in this P0 or any other variable. So this P0 is something which I'm trying to figure out. So to know that, let's say I just switch color because there's too much of things written here. So I think a different color would be easier to differentiate. So let's say I've been given an interest rate as 12%. Let's say my time to maturity is 3 months. Now, if I would want to know the PV of my portfolio, so can I say that the PV of my portfolio is written as 4.5 into e raised to minus RT. So e raised to minus 12% into 3 by 12. So can someone help me with this exponent, please? How much would be this number? So in the meantime, I'll just write the next step. So I'll just write it here, and there's white space. So we are trying to estimate P0. Therefore, we have 20, which is the stock price, which is the spot price, into delta number of shares, minus P0, because I don't know what the option price is on my initial node. And can I say this is equal to my this value? So if someone could tell me this number, I'll just plug that in. So 4.5 into this exponent. I'll also just open Excel on one side.
0.970, sir.
0.9. No. Can you tell me this entire number, please? 4.5 into that exponent.
So 4.367.
Okay, thank you very much. So this is 4.367. So let me just complete this and then I'll tell you what we have done, or we'll just do a quick recap of the steps. Also, could someone just help me with this as well? So, or no, actually, this is pretty easy. So I just need to move P0 on one side and this on the other. So roughly I get P0 to be equal to 0. Can I say roughly 0.66364, roughly. Yeah. So let me tell you what we have done. So we have started with a very simple setup, and our idea is to create a portfolio which is riskless in nature. When I say riskless, I'm trying to eliminate any kind of uncertainty in my portfolio. So that is at my cross section of 3 months, I want to eliminate any kind of uncertain values in the portfolio. So what I do is I take a very simple setup. I take one short position in the option and I combine it with a long delta number of shares. So as a first step, I want to figure out the best fit value for delta, so that once I have figured out that delta, it will make my portfolio riskless in nature. So I've just, as I mentioned earlier, I've plugged in some hypothetical values here, 20, 22, 18, and I've taken option prices as well as 1 and 0 at terminal nodes. And I just plug them into the first steps. So step 1 and step 2 is nothing but a representation of what the portfolio would look like. Now, why 22 delta into 1? Because 22 is the stock price at S1, and I am delta number of shares that I am long. So 22 into delta minus 1. Minus 1 because we are short one option. So whenever we are short, we always write a negative. Similarly, I do it for S1 dashed as well. Now, in order to create a riskless portfolio, I need to equate A and B together. So I equate them and I get a value of delta, which is 0.25 shares. So that means if I purchase or if I'm holding long 0.25 shares of this particular stock, my portfolio would be riskless. That is what we demonstrate in step number 4 here. So if I simply plug the value of delta into A and B, I end up with 4.5 in both the scenarios, because finally I've chosen that optimal value of delta whereby I have eliminated uncertainty. Now, my final aim is to understand how much the option price is worth today, because that's the real game, right? I mean, we want to know how much is the price for the option so that we can mark it on our books or maybe report it to the regulators, RBI, or other things which we discussed when we talk of option pricing. So we are interested in this P0 bit because we are standing today. So we want to know how much our investment is worth today. So for that, what I do is in step 5, I do a simple discounting. So I just try to figure out how much is the present value of my portfolio. So I have 4.5, which is the value of the portfolio at the terminal node at the 3M point. So I bring it back by the discount factor, and that gives me around 4.367. So this is the PV of my portfolio. That is, I have brought this back one step. So from S1, I have moved to S0. That is, from T equal to 3M, I have moved to T equal to 0 because I have applied the discount factor here. Now, what I do is I simply equate this value with how much the portfolio cost is as of today, or how much the portfolio is worth as of today. And I know how much that is, isn't it? Although not in entirety initially, because I write it as 20 into delta minus P0, which is my initial setup, because 20 is the spot price. I have this optimal value of delta, which is 0.25 minus P0. P0 is something which I'm interested in calculating. I don't know it right now. I equate this to 4.367 because both of these are portfolio values at the exact same time point at this S0 or at T equal to 0. Because this is discounted value, that is, I'm bringing it back one step. So this is PV. And this is also the value of the portfolio standing today. So both of them are exactly pointing to the same time point, t equal to 0. So that's why I can equate them. So I equate this and I calculate the value of P0, which roughly comes out to be 0.64, 0.6364. And this is what I can say is the option price as of today. And this is using the concept of no arbitrage pricing. So any questions in this setup?
So,
FE guys might be familiar with this, but IB guys. Yeah, please go ahead. Anyone.
so I didn't understand what you did after step 5.
Okay, yeah. So what I've actually done is I have simply equated two portfolios. So if you see in step 5, what I've done is I have simply taken discounting. So this 4.5 is something which is standing at, so maybe let me just switch inks. I can do the simple working here. So just an explanation. So in step 5, what I've done is I have brought 4.5 back to present because at t equal to 3m, my portfolio is worth 4.5. So in order to bring it back to today, that is at t equal to 0, I am applying a discount factor. So after applying that, I come out to 4.367. So this is what we did in step 5. Now in step 6, what we have done is we have simply we have just equated the portfolio values at the exact same time point. Why I say exact same time point? Because if you forget everything and if you just focus on this first node or this terminal or this root node, I would say, how much would be the portfolio value as of today? So that would be worth, so at S0, my portfolio would be worth 20 into delta minus P0, assuming I call P0 as the option price as of today, which I'm trying to figure out. So can I say this is the value of the portfolio standing on S0? And I can just plug in the value of delta because I know that. So can I say that the portfolio value standing today, assuming S0 is today, that is 20 into 0.25 minus P0. So would this be a right way of putting it? So does this
Yes,
sound
sir.
okay?
So S
Okay.
S here is the portfolio value. What does P signify here in this equation?
So S0 is the underlying asset actually. So S0 is my underlying stock price. S1 is also my underlying stock price, and S1 dashed is also the underlying price. And here P0 is the option price. So this is what I'm trying to figure. And this option is a part of my broader portfolio. So if you see, my portfolio is a combination. I am long delta number of shares and I'm short one option. And I am interested in calculating this value of P0. That is, I want to estimate how much the option is worth today. And that is what I represent through P0. So all these SS are underlying prices or underlying asset prices, and P0 is the option price which I'm trying to estimate.
Okay, sir.
Any questions? Yeah. And then, I mean, since we are looking at the portfolio values which are exactly at S0, I can simply equate because this is also the value at S0 and the thing on the left hand side is also the value at S0. So since both of them are at the exact same time step, I can just equate them and I can solve for P0. And that's how I equate these two sides and get the value of P0.
So why are we subtracting P0 if we are short in option?
Because whenever we are short a position, we take this negative sign. So that's why minus P0.
But in the portfolio value, wouldn't it be a positive? Like we are profiting
No,
in the
because
premium.
a short position is, you can imagine, is a liability on you. So whenever you're taking short option positions, you represent it by a negative value. Now, a premium payment which you receive is like a sunk cost because it's or maybe a sunk revenue, I would say, because that is something which you receive at the outset. So that is done. Now, once you cross that point, the premium has no role to play unless, of course, finally you're calculating your profitability. But other than that, for option pricing per se, that premium is something which we don't really have to worry about once we have traded that option. Then we are interested in how much the option position is worth.
All right, sir.
Yeah. Any more questions? Okay. So IB guys, does this look okay? And because you're looking at options for the first time, does this look fine? Any further questions? Okay. All right. So good. I mean, we are done with part one. So we'll just keep a track of this 0.64 or 0.65, whichever we receive. And that is something which we are going to use later on. So let me just, so once you're done noting this down, please let me know. I'll just erase screen so that I can do the next working. Now we have done it for one step. So I would like to slightly generalize this so that we can use it for n number of steps as well, because finally it is n number of steps which you are going to use in practice.
Sir, how do we know what will be the price after 3 months?
So you can apply the payoff, right? So we can apply option payoff and figure that out.
Okay.
So can I erase the screen? So can we go to the next step?
Yes, sir.
Okay. So there we have plugged in some values. So rather than values, maybe let's try to plug in some variables so that we can generalize things. So generalizing our one-step setup. So I can call this as maybe S0. And we'll not use any numerical or any numbers now. Let's say this is S0 into size of up move and S0 into size of down move. Let's say this is the option price in the upper node and this is the lower node. So that way, imagine that you're just plugged in the same numbers as the previous setup. Only thing is we have not really used numerical values. We have just kept it as generic numbers or generic variables, I would say. So essentially the setup is the same. We are long delta number of shares and we are short one option. So the setup remains exactly the same as we had done earlier. And we are again trying to create a portfolio which is riskless in nature. That is, we are trying to eliminate uncertainty with what happens at my nodes. Let's call this maybe node 1, node 2, and node 3. So whatever happens at node 2 and node 3, I should be indifferent about it, or it should not have any impact. Basically, there should not be any risk. Yes.
So here when we say that we are short one option, we are still talking about calls, right?
So right now, don't worry whether it's a call or a put option. So for this analysis, that is not really required. This will be applicable for both call as well as put. So don't worry about what nature of the option it is. It's more of the concept which we are focusing on right now.
Okay, sure, sir.
Yeah. So when we do the numerical, then we'll actually talk about calls and puts. Yeah. So again, using the similar setup like last time, if I were to calculate this optimal value of delta, can I write this as, so I'll just eat up those two steps and write it directly. So can I say S0U delta minus FU is equal to S0D delta minus FD. So there we just had, I think, 22 and 1 and 18 and 0. So in place of that, we are just having variable names. That is it. So again, here I'm trying to figure out the optimal value of this delta parameter. So if I just play around a bit and if I write delta, so I can represent this as, so if I move FU on one side, so FU minus FD upon, I have delta common, so S0U minus S0D. So does this look something familiar? So something which our financial economics class might be aware of. So does this representation look familiar to some concept which might be covered earlier?
So hedging.
Okay, something related to hedging, yes.
So value of portfolio, if I'm not mistaken.
Not exactly. I mean, value of portfolio, anyways, we are trying to figure out. So that S0 is something we, or at node one, that's we call as the value of portfolio. But anything which this equation looks very, very similar to. Or maybe if I write this as df by ds, would this look something similar? Or maybe if you want a partial derivative, would this look something which you might have studied earlier?
We're not sure, but it seems like we're trying to calculate the value of one of the Greeks.
Absolutely. So can you recollect which Greek that is?
So I want to say delta, but it sounds too easy.
Absolutely. No, no, it is the delta.
Okay.
You're correct. So that way, technically, this is delta. So the meaning of delta is, so when you say it's an option delta, you also call it as a delta. So this is nothing but the change in the option price for a given change in the underlying. So this is how you generally write a delta. Or you can write it this way as well. We have simply replaced V by F, just the variable change, nothing else. But a delta is defined as how sensitive my option price is to the change in the underlying. So that way, as the underlying changes, my delta also moves. So as Ali rightly said, this is a representation of delta. Only thing is this is in a discrete form because I have written Fu minus Fd upon Su minus Sd. If I write this in continuous form, it would look something like df by ds. So that way, these are equivalent. This is something in discrete time and this is something in continuous time. So good. So this is the technical definition of delta. Now, subsequently, we'll talk a bit about option Greeks in our later classes. But for the rest, and this is one of the Greek parameters which we frequently monitor as well. So that way, we are simply borrowing the concept here. So this is technically the definition for an option delta. This is technically option delta. Or maybe I can write technically the option Greek delta. Now, if I go back to my portfolio for a minute and basically with the point of view of generalizing the setup. So if I do just a couple of steps, so we are at 7:30. So let me just complete this working and then maybe we can take a break for 5 minutes because we are in the midst of this. So I would like to complete this before we take a quick coffee break. Now let's say that I want to know how much is the PV of my portfolio. So maybe as step one, I would like to say what is the PV of my portfolio, how much that would be. So can I write this as, so let's say I end up at the top node. Can I say this is e raised to minus RT into S0U delta minus FU. So can I say this as the PV of the portfolio? I'm simply moving from node 1 to node 0. That is, let's say I'm at point 2, I'm just moving from point 2 to point 1. The same thing can apply for S0 into D as well. I could end up in either of the nodes, but I'm creating a riskless portfolio. So whether I talk of node 2 or whether I talk of node 3 should not really impact our analysis. So that's why I simply apply an exponent term for discounting. So exactly the same thing which we did for the earlier example as well, whereby we had 4.5 and we simply applied the discount factor to bring 4.5 to today. So that's how we get to the PV of the portfolio. Also, can I also say that the cost of setting of the portfolio or maybe how much the portfolio is worth today? Can I write that as S0 into delta minus F? Let's say F is my option price here and F is something which I'm trying to figure out. So F is my unknown here. So if I just do a bit of rearranging, so before I rearrange, of course, I'm going to equate 1 and 2 because both of these are pointing to the same time step. Even this is pointing at time step equal to 0, and this is also pointing at time step equal to 0. So exactly the same thing like last time. So whereby we had equated that 4.36 or something versus the portfolio value standing today. So again, equating these two, I can write this as e raised to minus rt into s0u delta minus fu is equal to s0 into delta minus f. So if I just rearrange and I write the equation for f, so I get something like, I'm going to introduce one more parameter here. So I'll tell you what that parameter is. So let me just complete that first. So e raised to minus rt into p into fu plus 1 minus p into fd, where p is equal to e raised to rt minus d upon u minus d. So what you have actually done is we have introduced one more variable, p. Now, why that is required? Because we need to associate certain probabilities with the movement in either the up node or to the bottom node. So we say p is the probability of moving in the upward direction, and 1 minus p is the probability of moving in the downward direction. Now, they should equate to 1 naturally because finally we only have just two states of the world, isn't it? So finally they should sum up to 1 because we know that the probability should sum to 1. So we have p and 1 minus p. So this p is defined as the probability of up move, and 1 minus p is nothing but a subtraction of this. So 1 minus this p will give me the probability of down move. And u and d, which I have written earlier. So this is defined as the size of the up and down move. So for our discussion, we'll take u and d as ready-made values which are available for consumption. But otherwise, u and d is something which you need to relate with the underlying volatility. So that will slightly complicate things, but for now we don't need to do that. So even in our examples which we take right now in class and even for your examination, we will take ready values for u and d. And of course, p is something which we'll calculate because once u and d is available, it's easy to do. But calculating u and d can be slightly challenging because that needs to be understood through what we call as the concept of modeling volatilities with u and d or matching volatilities with u and d. So something which you can generally refer to later on, but for the current discussion, that is something which we will not get into. So we are going to require this value of p frequently in our calculations because without that, we will not be able to calculate the overall option pricing or calculate the value which we are interested in. So we'll make a note of this and something which we are going to use. So this one as well as this value of f. So two important points. Now, the reason why we have done this generalization exercise is to get to these two results, which we have shown in red. So result A and result B. Because once we have these two concepts, this will form one side of our analysis. And when we relate this with risk neutral valuation, we will be able to relate these concepts there. So that's why these two things given in the blocks are important. And this is what we are going to use in our actual numerical examples now, as well as on the exam also. So that way, if you see the logic which we have followed is exactly similar to our earlier analysis. Only thing is, rather than numerical values, we have used variables. And the idea behind using the variables was we wanted to introduce this concept of probabilities here. So that's why we have kept it as a generic representation. And since it is generic, I can extend this to n number of binomial steps as well. So we are gradually trying to move in that direction. So does this look okay? Okay. All right. So we are at 7:30, 7:35. So let's take a quick 5-minute break. When we come back, we will relate this with risk neutral valuation. And once we are familiar with that concept, we'll try to do a simple numerical today. So maybe we can take a two-step binomial and we'll try to solve that binomial so that you know how exactly you can price options using a binomial model. So that will be like the something which we can do in the latter half of this. So probably after 8 o'clock, we can do that. And I mean, once we are familiar with these concepts, applying it to actual numerical is not very difficult. But the risk neutral bit and no arbitrage, that is something which is the key, not just now, but even later on. So maybe on your interviews now, or possibly even on your jobs, these are the things which will come very, very handy. So let's take a quick 5-minute break and we'll be back by 7:40. So is that okay?
Yes, sir.
Okay. Hi guys, can we resume? Is everyone back?
Yes, sir, we can review.
Okay, okay. Uh, so maybe we can have one interpretation for this result on F, or for F on step number 4. So maybe if I just erase this top section for a moment. Can I say that if I were to write this in plain English, step 4, can I say that the value of the option is the expected future payoff of the option discounted at RFR. So we use R as the risk-free rate in our analysis. So can I say that assuming R is my risk-free rate, this is the interpretation, because if I were to just link this equation in 4 with this definition in orange, my expected future payoff, these words are nothing but the thing which I've shown in these square brackets here. So these square brackets is the representation of my expected future payoff. And I say I am discounting it at RFR. So this exponent term is nothing but the discount factor. So that's how I can write this equation 4 in plain English as the value of the option, which is small f on the left hand side. This is nothing but the expected future payoff, that is the one in the square brackets, discounted at the risk-free rate. So that's how I would want to interpret this expression 4. I'll just delete a small section, or maybe I can just erase the below part. This is something which I'll remove because I want to relate this with what happens on the stock price front as well. Now let's see how exactly or maybe we should try and relate this with the expected movement in the stock price as well, because so when I say stock price, guys, I'm just talking of equity right now. You can relate this with FX as well. So you may have a FX option. So just imagine this to be like an underlying asset. So here we are taking a stock. So I would want to know what would be the expected stock price as well, or maybe what would be the stock price at the future nodes. So when I say future nodes here, I only need to worry about these two nodes. So I could write something like E of ST, that is the stock price at this terminal node, or capital time T. This is nothing but P, which is the probability of up move, into S0U plus 1 minus P into S0D, because I know P and 1 minus P is the probability of either the up move here or down move, 1 minus P. And I just relate it with the quantum, which is S0U and S0 into D. Now, if I plug in the value of P, which we have just calculated some time back, so if I plug in, plugging in P equal to E raised to RT minus D by U minus D into above. So I'll just simplify it directly. So we get something like E of ST is equal to S0 into E raised to RT. So the interpretation of this is the stock price grows at the risk-free rate, because R is the risk-free rate, and the expected value of stock at time capital T, I can write this as S0 into E raised to RT. So I say that my stock price today will grow at the risk-free rate. Now here we are assuming a risk-neutral world. Now why I say risk-neutral world here? Because we are talking of a risk-free rate here, and whenever you talk of a risk-neutral world or risk neutrality, that means you assume that investors are neutral to the concept of risk. So all that they're looking at is the risk-free rate of return on their portfolios. So that is what we call as the idea of risk neutrality. And so no matter whether you end up at P or 1 minus P, and all the investors are looking at is the relevant risk-free rate, which is R in this analysis. So now I would want to again take a step back and use the numbers which we had used in our earlier analysis. And we have derived two results. So we had derived one value for small f and a value for P. And I would want to relate it with this stock price. So you can imagine this is, so I think we had given them as 1 and 2. So you can call this as 3. So this is the third concept which I'll again want to use in my analysis. So I will use the same numbers which we had used earlier. Only thing is now we are talking from a risk neutral perspective. That is, we are talking R as the risk-free rate in our analysis. And we have this expression for the stock price as well. So I would want to use this or use the numbers in this analysis, and that way we need to we just check that our answers tally with what we had done earlier. So if I recollect, I think earlier we had calculated a value of 0.64 or something using the idea of no arbitrage. Now a similar value, actually the same value, if we ignore any kind of rounding errors, we'll end up with the exact same value using risk neutrality as well. And the reason why we end up with the same value, that is because we are essentially pointing to a similar concept. Because when we talk of no arbitrage, what we are doing is we are trying to eliminate the riskiness which is there in the portfolio. And when I say that I have eliminated the riskiness in the portfolio, how much should be the return that I should earn? So any asset which doesn't carry a risk, what should be the return that I should expect on that asset? Anyone?
To the risk-free rate.
Absolutely. Very good. So take a simple example, a government security. Now we know that a government security is a risk-free asset. So whenever you make an investment in the GSEC, you are expected to earn the risk-free rate because it's a risk-free asset. So all that it is going to generate is the risk-free rate, and that's it. You're not going to get anything above that. So in our initial condition, whereby we had solved for the no arbitrage pricing in our section 1, so there as well we had eliminated the riskiness in the portfolio. And whenever you have eliminated riskiness, that means you are going to earn the risk-free rate because you have eliminated any other possibilities. All that remains is you to earn the risk-free rate of return, because that is all that you can earn. There is no additional risk which you're carrying. And we know from a risk and return perspective, unless you take on more risk, you are not entitled for a higher return. So using the same logic here, since we are making the portfolio risk-less in nature, all that we can earn is the risk-free rate of return. And if I relate that with risk neutrality, then I know that in a risk-neutral world, investors are looking at risk-free rate of return only. And they're basically not looking at any other rate of return on their investment. That's what we call as the idea of risk neutrality. And both of them essentially talk of risk-free rate, because in our scenario 1, it's the RFR which we are earning. And in the second scenario as well, since it's risk neutrality, we know that we are talking again of risk-free rates only. Now, since both the ideas, no arbitrage pricing and risk neutral valuation, both of them point to exactly the same concept, our overall calculation should also match. So we already have one number for benchmarking. So we have this 0.64 which we can benchmark. So now maybe let's try to use the same values which we had used in our earlier calculation, but now we are going to use this new equations which we have. So we had that equation for E of ST which we have written here. So we are going to use this, and we are going to use this as well, S0 into e raised to RT. So I would want to use these two numbers. So possibly I can call this as block 4. So from your analysis perspective, the earlier two blocks whereby we calculated small f and small p, that we had called as 1 and 2. So those two and this 3 and 4, these are important things which are required for proving this result. So now for when I plug in values, I'm going to use block number 3 and block number 4. I'll continue to use the same values for S0U and S0D. So that way, I can tally my results with the earlier calculations, but I'll be using these two results to demonstrate that did tally. So I think in our earlier analysis, we had S0, which was 20. We had taken our time to expiry as 3 months. Our interest rate was 12%. On the upper node, we had 22. In the lower node, we had 18. So these were the things which we were given. Now, if I look at E of ST, that is, if I look at this right-hand side of this block 4, and if I try to solve that, so I can just plug those values in. So I don't know P right now. That is something which I'll solve. So can I write, or maybe can I equate 3 and 4, because they're essentially the same thing, isn't it? So if I plug in values, so I have 22. So I'm jumping from there to here. So I have 22, which is nothing but S0U. So you can, so just to make things easy, SU is same as our S1, and SD is similar as S1 dashed. So that way, I'm just using them directly. So coming back, I'm just using red color, right? Let me just continue using that. So we had 22 into P plus 1 minus P into 18. Now this I would want to equate to block 3, because they're essentially similar concepts. Or basically my left hand side is E of ST only. So I can use 3 and 4, or I can equate 3 and 4 together. So can I also write this as 20 into exponent E raised to RT? So 12% into 3 by 12. So this is in the exponent power. So now, can I request someone to solve this and give me the value of P, please? So what we are actually doing is we are working on the concept of risk neutral valuation. So this you can imagine as the section 2 of our analysis. Starting here, we have written the expression for expected value of the stock price at ST or E of ST. And we are trying to figure out this value of P. So once we get P, we can get 1 minus P as well. So on the left hand side, it will be 22. So it will be 4P plus 18. And on the right hand side, you have this exponent of 20.
0.65 value of P.
Thank you very much. So this comes out to be 0.65. So this will be around 0.35, ignoring any further decimals. Yeah. So generally, about the thing about decimals, guys, is generally for these kind of calculations, 2 decimals are good enough. But when you talk of things like FX, etc., you stick to 4 decimals. So if you're talking of something on USD INR, you should always use 4 decimals, because that is like the market convention. But for these analysis, maybe 2 decimals should be good enough. Of course, if you're trying to maybe narrow down on any model differences, you may have to use some larger number of decimals, but generally 2 decimals are good enough for this analysis. If you can have more, yes, if that kind of accuracy is expected, you can definitely use that. Now, if I want to know the expected value of the option, that is, if I relate this with the equation for small f, which we had written earlier. So we had f equal to that exponent term, and in the brackets, we had p into fu plus 1 minus p into fd. So if I use that equation now, so let me just delete a few sections of this. So maybe I can delete everything at the top. This is not really required now. So what I'm going to do is I'm going to use these values, p and 1 minus p. And I'm going to use this equation for small f, which we had just calculated some time back. So before we switch to the risk neutral idea of things, this is something which we had used in our generalization of the one-step bit. So this was e raised to minus rt into p of fu plus 1 minus P into FD. So this is something which we had used earlier. So I'm going to use this. So now we have e raised to minus 3% into 3 by 12. Sorry, this is 12%. My mistake. 12% into 3 by 12 into 0.65. Now my upper node option price or the payoff was 1 and the lower node payoff was 0. So I'm just using the same numbers which I had done earlier. So I'll just write as well what these 1 and 0 are. So this is the payoff at upper node and this is the payoff at lower node. So this is exactly the same payoff which we had used at the start of the class. The payoff at lower node. So could someone give me this number, please? So it's simply this discounting term and 0.65. This second term will vanish because it is 0.35 into 0.
So 0.63.
Absolutely correct. So 63, if you maybe round it off, it could possibly be something like 0.64, which we had calculated earlier. So that way, we again end up with the same value for the option as we had calculated earlier. So in our earlier calculation, I think we had called it as P0 or something. We had calculated 0.64 at the very start of the class. Now we have tied that concept with risk neutrality because to get to this value, we have used these two relations, which we borrowed from the idea of risk neutral world. So for option pricing, we always take a world whereby investors are neutral to the concept of risk. That is, they are looking at risk-free rate as the only rate for analysis. So through that, we get this expected value for stock prices. We solve the value for P. And then we simply use the same definition for option price, something which we had written in a definition plain English form as well, whereby we said that the option price is nothing but the expected future payoff of the option, which is discounted at the risk-free rate. So this is the expected future payoff for the option, and this is discounting at the risk-free rate. And that is how I get to 0.64. So that's why these two concepts, risk neutrality and no arbitrage pricing, tie up together. They are pointing essentially to the similar idea of risk-free rate of return which investors are looking at. And these two are things which we require again when we talk of Black-Scholes and any other options models as well. So any questions for anyone? So we will solve a numerical. So that will give you further idea as to how exactly you can build a binomial option pricer in case you want to build one. But this is the underlying idea behind risk neutrality and no arbitrage. And these are the things which you will frequently come across in any literature which you look at. So be it John Hull or Wilmot or any other reference book which you are referring to, or any other content on the internet as well. And these ideas will frequently come up. But now this is the basic concept behind what these names, risk neutrality and no arbitrage pricing, mean. And in the meantime, we also came across delta because when we generalized the setup, we came up with the actual definition for delta as well. So we will be using that going ahead. So we will discuss Greeks a bit as well in our future sessions. But that is also something which we came across for the first time. So now let's try to apply this to a simple numerical example. So let's take a simple two-step binomial. Now we have done this analysis for a one-step binomial. I did that for a one-step because it is comparatively easy to understand because we are learning these concepts for the first time. So only complicating stuff it would not have helped. So we generalize this thing for a one-step binomial. Now we can extend this for an n-step binomial. Now, naturally, I'll do it for only a two-step because manually doing an n-step binomial tree will be painful. So you can do that through a computer program. So maybe after we do this numerical example, you'll know the logic as to how exactly you solve for an n-step binomial as well. So possibly you can try a simple hands-on varieties after that as well. So let's try a simple numerical. So are we set? So can we try a simple European put option and try to see how to price that option? Are we good to go? Can we try that? Is everyone awake?
Yeah.
I hope I have not bored you guys too much.
Yes, sir.
Okay. But actually, no, these concepts may appear to be initially slightly tricky. They are, but that's the point, right? I mean, since you learning these concepts for the first time, they may be difficult, but this is something which will help you later on. So it's always good to tackle the slightly complex things now, so that later on you can explore them more. So that's why we are spending time understanding these concepts. Otherwise, we could have simply taken the numerical and that could be the end of it. But I did not want to do that because you should be familiar with these ideas, because without that, understanding Black-Scholes is difficult. So that's why we have done this effort. Now, let's take a two-step binomial. So let's take a two-step tree or a two-step binomial tree. And let's take a few inputs. So let's say I have a time to maturity of 2 years for this option. Let's say my current stock price is 50. Let's say my strike price is something like 52. Let's say my risk-free rate is 5%. And the size of up and down move, it's 20%. This is given to us. So we'll use it directly. So basically, rather than this, I can just write U and D in actual form. So rather than writing a percentage, I can just say U equal to 1.2 and D equal to 0.8. Okay, yeah. So now let me draw a two-step binomial. This is step 1. This is my step 2. Okay, so maybe let's give these names. So we have A, B, C, D, E, F. Imagine it's a European put option. So now, for the first time, we have actually taken the names calls and puts. So we'll do it for a put option. Now let's start. So as a very first step, let's try to fill up the stock prices at each of these nodes. So I have S0 as 50, which is the current spot price which is given to me. Now I can use these values of U and D, which is available for filling up the stock price at each of these nodes. So I know U is the size of the up move and D is the size of the down move. So that is something which I'm going to use to calculate these stock prices at all of these nodes. So let's say I call this as S1. So S1 will be 50 into 1.2, so 60. I can call this as maybe S1 dashed. This can be 50 into 0.8, which is 40 units. Now, to get to the node D, I have, let's say I call this as S2. So 60 into 1.2, which is 72. Let's say this is S2 dashed. I have 60 into 0.8, which is 48. And let's say I call this as S2 double dashed. So 40 into 0.8, which is 32. So what I've done is I have simply tried to calculate what will be the stock prices or what will be the evolution of stock price over each of these nodes. And for that, I've used the values of U and D, which is given to us. So all of this is simply multiples. So if I have to calculate the value at B, I simply take 50, which is the value at node A, into 1.2. So that's how I get S1 equal to 60. To get S1 dashed equal to 40, I simply take 50 and I multiply it by the size of down move, which is 0.8, which gets me to 40. And accordingly, I get to S2, S2 dashed and S2 double dashed as well. So I just use these stock prices at the node where I'm standing, and I take the size of the up and down move. So is it okay up till now?
Yes, sir. Good.
Okay. Now, as a next step, let's try to calculate the value of P, which we call as the probability of up move. So once we calculate the value of P, value of Q is nothing but a 1 minus P. So let's try to calculate the value of P first. So maybe as step 1. Now, value of P, I'm just using the same formula which we had written earlier. So E raised to RT, which is my time step. So my time step, by the way, is 1 year. So this is, I'm just dividing this binomial tree into two steps, 1 year and 1 year. So e raised to RT minus D upon U minus D upon 1.2 minus 0.8. Can someone give me this value, please? So once we get P, we can have 1 minus P as well. And this is just the usual formula, e raised to RT minus D upon U minus D. So the same thing which you have studied earlier.
So 0.628.
Okay, thank you. So maybe 0.62. So maybe I can write this 0.62 only. And yeah, so this will be roughly 1.1 minus P will be roughly 0.37, 0.38. Okay. Yeah. Now, I would want to start from my terminal nodes. So the approach which we follow for the binomial model is we start from the terminal nodes and we step back in time, and we step back one step at a time. So I need to apply my payoff conditions now. So let's call this as maybe P2. Let's say this is P2 dashed and P2 double dashed. So now because up till now, if you see, my model doesn't know that it's a put option because I have never really done anything which is specific to put options. So now for the first time, I'm going to apply the payoff condition for the put. So which is nothing but max of K minus ST or 0. So this is what I'm going to apply now because I have a put option and I have to start from my terminal nodes, which is right here, and I need to keep stepping back. So I need to figure out P2, P2 dashed and P2 double dash first. So that is what we'll do. So let's plug in the values. We know the value for K, which is 52. This is the strike price which has been frozen as a part of our contract. So value for P2, this will be 0. P2 dashed will be 4 units. P2 double dashed will be 32 minus 52. So this will be 20 units. So what I've done is I have simply used this condition and I have plugged in the values of ST. So at S2, we had 50, so we had max of 52 minus 72 or 0. So that's why we got a 0 here, which we had represented here. Similarly, here it's 48, which was the stock price. So that gives us a positive value of 4 units and similarly 20 units. So that's how I get P2, P2 dashed and P2 double dashed. Now, I know the stock price at my, I know the option price at the terminal nodes, but that is not enough, right? Because finally, I want to know how much the option price, let's say I call this as P0. How much this P0 is worth? This is the real deal which I'm trying to calculate. So how do I get to that? So I have applied my payoff conditions at these terminal nodes, D, E, and F. So now, can anyone figure out how exactly do I calculate the option price at B and C? So let's say I want to calculate P1 and I want to calculate P1 dashed. So any idea how do I come from these terminal nodes up to these intermediate nodes, B and C? So how do I calculate P1, P1 dashed? Anyone? So can I apply the payoff condition again? That would be easy, right? And can I do that?
Sir, no, sir, we cannot apply the payoff condition because it is a European
Okay.
option, so we can exercise that at the expiration only.
Correct. Absolutely. So I cannot apply the payoff condition again. So a very good point. Yes. So that's what I was looking at. So correct. So I cannot apply the payoff at B and C again. The reason is this is a European option. And we know that European option can be exercised only at maturity. I cannot exercise it at any of these intermediate points, and B and C is an intermediate point for me. I can't do anything about the option at that point in time. So I cannot apply the payoff at B and C. That is correct. Correct. So now can you think of an approach how I can step from D and E into B? So maybe you could just focus on this top triangle at the moment. And would anyone like to try that? Standing on D and E, how do I come to B?
So by finding out the expected value.
Correct. So the exact relation which we have discussed earlier. So maybe as step 2, or possibly I can just write this as value at B. So value at B is nothing but discounting first. So e raised to minus RT into, we have 0.62 into the upper node which is feeding in, which is 0, plus 0.38 into the lower node which is filling in. So now currently you don't have to worry about node F, because that we are not really looking at, because the nodes which are filling into B are D and E. So we need to focus only on this triangle in purple and nothing else. So this is into P2 dashed, which is 4 units. So we get something. So can someone help me with this value, please? So in the meantime, I'll just write the value for C as well. So again, value at C will be similar, applying the expected payoff for the option. So 5% into 1 into 0.62. So now for the below one, let me just draw some other color triangle. So let's say I draw an orange color triangle. So now for node C, I need to focus on the orange color triangle. So I need to worry only about E and F nodes. I don't have to worry about the node D when I'm looking at C, because D and C are not connected, isn't it? So this would be 0.62 into the upper node, which is 4 units, plus 0.38 into the lower node, which is 20. So request you to help me with the value for C as well.
So,
Yes.
so we are using the F formula here, right?
Yes, correct.
That first formula.
Yes.
Okay, sir.
Yeah. So the bracketed, so exactly as per the definition, the bracketed term is the expected payoff for the option, and this is discounting it at the risk-free rate. So you're right. You are using it for the small f thing which we had written earlier. Correct. Good.
Sir, for value at E, node E, it should be
Uh-huh.
max of what? What to value?
So for a value at E, this will be max of K minus S or 0. So it is max of 52, or so if I say value at E, this is nothing but my payoff condition, which is max of S of K minus ST, which is 52 minus 48, which is nothing but S2 dashed or 0. So max of 4 or 0, that's how we get to 4. So which we have written right here in P2 dashed.
Okay, sir.
So, so we'll get these values. I mean, someone will so request someone to calculate. So now, can I request someone to maybe figure out what should be the value at A? So how do I calculate the value at A? So maybe can I request someone from IB class, because you guys are looking at this for the first time. So would you like to extend the ideas which you have applied at B and C, and would you like to help me figure out the formula for value at A? Anyone? So request someone from the IB section. So you guys can give it a try, even if it
Sir,
is
I can
incorrect,
try.
it doesn't matter. Yes, we would. Please go
Yes,
ahead.
sir. So similarly, like e to the power minus 5%,
Okay, correct. Yes. And let's say for
and
now,
then bracket.
let's call this as X and Y. So maybe later on you guys can calculate this. No problem. Yeah, Vibhor, you can use X and Y in the analysis now.
Right, sir. So 0.62 into
Uh-huh.
the value of B, which is X,
Correct. Very good.
plus 0.38 into Y.
Very good. Correct, Vibhor. Yes. So later on, request you to just calculate these numbers, and let's say I write this as Z. And let's say Z is nothing but P0. So you can do the computations later, no problem, but the steps will be essentially the same. So just doing a recap of what we have done here. So we have taken a European put option. Now, as a very first step, what we did was we tried to populate what the stock prices are at the respective nodes. So that was step one, because we were given S0 and we figured out what was S1, S1 dash, etc. using the values of U and D, which were provided to us. So that was the first thing. Next was we calculated the probability of up move using the normal formula which we have, e raised to RT minus D by U minus D. So that helped us come out to 0.62, and 1 minus P is just the difference. Then we applied the payoff. So for calculating P2, P2 dashed and P2 double dashed, we applied a simple formula for option payoff, that is max of K minus ST or 0. So that was the very first time that our model understood that we are looking at a put option. Up till that, we did not really talk about put at all. Subsequently, we have to step back in time, isn't it? Because all we are interested in is P0. This is the MTM for the option, or how much the option is worth as of today, the fair value for the option. So standing on, so if I focus on the upper triangle, I stand on D and E and I take a step back at B. For that, I use the formula for small f, which we have just discussed some time back. So it's nothing but discounting my option payoff or expected payoff of the option. So value at B, this is e raised to minus RT, which is the discounting term, into the brackets. This is just P into, that is the probability of up move, into the node or the option payoff at the up node, plus 0.38, which is the probability of down move, into the option payoff at the lower node, which is 4. So that we have just generalized this as X. You can solve this later. You can replace X with the actual value. I do the same for C as well. Now for C, I need to focus only on the orange colored triangle, because only E and F are feeding into C. So I need to worry only about E and F when I look at no value at C. So again, using a similar analysis, I get to a value of Y. And for A, again, I just extend the analysis and I use this triangle in red. That is, I need to look only at nodes B and C, which are filling into A. And that gives me, I've just written this as Z. You can write this later. This Z is nothing but the value of the option as of today. So any questions on this approach?
There is one question you might have mentioned it before
Yes,
also,
please.
and I might have missed. But in this case,
No
we are
problem.
still longing a put, right? What if we had taken a short position on either call or put? Because then the payoff diagram would be inverted, right?
Correct. Yes.
So then how do we go about this? Plus
So
the bigger problem over there is my loss will be unlimited, right?
for put, yes, your loss will be unlimited. Correct. So what you do is,
So
and the
then
option, so the nature of the option pricing model doesn't change depending on whether you're looking at a long or a short position actually, because essentially here, if you see, we haven't really considered whether we are holding a long or a short put position. We are just taking that we are holding a European put, and accordingly, we are trying to estimate what the value is. So that way, that position won't really matter much. Your premium has already been taken care of, so that premium payment will not come in here. But even finally for a seller as well, one will need to mark their books, right? So this is how you can mark your books.
Okay, sir. And so one more question. It's a bit
Yes,
big
please.
actually. From the so sir, from what you explained right now, this looks like something that's gonna be very resource intensive for the for the company's setup, and you'll also need somebody who really knows what they're doing, right? I imagine this is gonna be a very expensive thing to actually implement. So then, if we are
Yes,
trying to
please,
get
please go ahead.
to a so then, sir, if we are trying to get to a say a no profit, no loss situation, how do we account for the overheads also?
So yes, I mean, if you're looking at specifically delta hedging your position, then again, we don't really do delta hedging continuously. So that is something which we do discreetly. So can I request you to hold on to this point till we discuss Black-Scholes, because that is where we'll talk a bit about complete markets and about continuous and discrete delta hedging. So can you hold on till then?
Okay, sir.
Yeah. So our IB class, does this look okay? I mean, you guys are looking at these concepts for the first time. Does this look manageable?
Yes, sir.
Okay. Now, just one small follow-up question. Now, if I have to do it for a call option, what would change? So imagine in place of a European put, I have a European call. Then what is that thing which will change? And everything else remains the same.
Sir, payoff
Absolutely. Very good.
condition.
Very good. So that is the only thing which changes. So let's say I call that as C2. I call that as C2 dashed and C2 double dashed. So the only thing which will change for a call option is that my payoff condition changes. So rather than writing max of K minus ST or 0, I will just switch to max of ST minus K or 0 at my terminal nodes. That's it. After that, your entire setup remains the same. So whatever happens at the intermediate nodes doesn't matter. Now, what matters is the payoff condition which you apply, which is at your terminal points. So you only switch from max of K minus ST to max of ST minus K, and you can handle a call option easily. Very good. Yes. So that's the only change which happens. Otherwise, things remain the same.
Sir, I have a doubt.
Yes, please.
So can you explain why this condition changes?
Yes, because if you see, this is the only place. Now, the place where I'm applying the payoff, that is the only point when I'm telling the model that what type of option it is to price. Because if you see that initial stock price evolution, calculation of this value of P, etc., we did not really bother as to what type of option it is. Now, this is a model which you can apply for both calls as well as puts. So you need to communicate to your model as to which option you are looking at, whether it's a call or whether it's a put option. And through the payoff condition, we try to communicate to the model that whether it's a call which we are trying to price or whether it's a put we are trying to price. And initially, when in our example, we have taken a put option. So we applied the payoff condition K minus ST. So through the payoff condition, now the model knows that we are handling a put option. Without applying the payoff, model will have no clue as to whether we are looking at a call or a put, because it's the same model which you can use for both the options.
Okay, sir, understood.
All right. So good. So that way we have covered a good bit of ground today. And binomial model is a good stepping stone. So that way understanding things on the continuous time also become comparatively easy. So we'll stop at this point. So now we know basic concepts, no arbitrage, risk neutrality, etc. So in tomorrow's class, that is in our Wednesday's class, we'll do a few things which are specific to randomness, which you see in assets. So things like maybe scaling of mean and variance with time, and then relating them further with the idea of a geometric Brownian motion, etc. So basically, we are trying to understand the evolution of a stock price at that time. So that is, we are gradually making a step from discrete to continuous time. So you can imagine The next two sessions are going to be like a bridge, which are going to help us move from discrete on to continuous time. So that is something which we'll discuss in our class on Wednesday. All right. So any questions on today's points as such? Okay. All right. So we can stop at this point. It's 8:30. So I won't really hold you guys back. I'll just mark the attendance for today. And I look forward to meeting you on Wednesday at our usual time. So Wednesday morning, again, I think we'll have a 9:15 class. So we'll take our discussion ahead at that time. Okay. So thank you very much. Thanks for joining in, and wish you all a good evening, and look forward to meeting you on Wednesday morning.
Thank you, sir.
Thank you.
Thank you, sir.
Thank you, sir.
Thank you.
Thank you, sir.
Thank you.
you,
Good
sir.
night. Yeah. Bye-bye.